Welcome back, Econ Junkies, to Boss Economics World, the only show where we break down the financial chaos of the world with the subtlety of a sledgehammer and the sass of a Wall Street trader on a caffeine bender. I'm your host, the Boss Economist, here to shine a spotlight on the economic dumpster fire of the day. And oh boy, do we have a doozy for you today, August 4th, 2025. Buckle up, because we're diving headfirst into the mess that is Donald Trump's latest economic fantasy, lower interest rates in a world that's screaming, nope, not gonna happen. Spoiler alert, this isn't just about Trump versus Fed Chair Jerome Powell. It's about structural forces so big, even the Donald's golden hair can't defy them. Let's get into it. So, here's the deal, folks. President Trump, yes, that Trump, back in the White House for round 2, has decided that interest rates are too darn high. He wants them lower, like, yesterday. And who's standing in his way? None other than Fed Chair Jerome Powell, the guy Trump loves to hate. But here's the kicker, my financially curious friends, Powell isn't the real problem. Oh no, no, no. The real problem is the economic equivalent of trying to fit a square peg into a round hole while riding a unicycle and juggling flaming torches. In other words, the structural forces driving borrowing costs are pointing up, not down, and no amount of tweeting is going to change that. Now, before you regular folks out there, yes, you, the ones refreshing your mortgage apps in despair, start yelling at your screens, and before you finance pros start smugly nodding along, let's break this down from the ground up. We're going point to surface, peeling back the layers of this economic onion until we're all crying tears of understanding. And trust me, I've got the latest data, the hottest examples, and enough snark to keep you entertained through the apocalypse. Let's go. First up, let's talk about the elephant in the room, or rather, the herd of elephants trampling through the global economy. Governments and businesses are piling on debt like it's going out of style. Why? Oh, you know, just the usual suspects, tax cuts, military spending, and the shiny new toy of the 2020s, AI investments. According to the International Monetary Fund's latest global debt monitor, global public debt has ballooned to a staggering 102% of global GDP, up from 83% in 2019. In the US alone, public debt is now approaching 125% of GDP, a level not seen since World War II. And don't even get me started on corporate debt. U.S. non-financial corporate debt hit $13.7 trillion in Q2 2025, per the Federal Reserve's Financial Stability Report, fueled by companies borrowing to fund AI data centers and stock buybacks. Now, here's the problem, folks, more debt means more demand for credit. And when demand for credit goes up, guess what happens to the price of borrowing? Ding, ding, ding. Interest rates rise. It's basic supply and demand, people, Economics 101. But apparently, someone forgot to tell the White House that you can't just wish away the laws of economics, no matter how loudly you yell, fake news. But wait, there's more. It's not just that we're borrowing like there's no tomorrow. The pool of savings to finance all this borrowing is shrinking faster than my patience during a central bank press conference. Let's break this down into bite-sized chunks, shall we? First, we've got the baby boomers, those lovely folks born between 1946 and 1964, who are retiring en masse. According to the U.S. Census Bureau, by 2030, all baby boomers will be over 65, and they're already spending down their retirement savings like it's Black Friday at the mall. The Employee Benefit Research Institute estimates that U.S. retirees will withdraw $4.5 trillion from their 401(k)s and IRAs between 2025 and 2030. That's $4.5 trillion not being saved and not being lent out to finance all that debt. Less savings, higher interest rates. Simple math, folks. Second, remember the good old days when China and the petrostates were buying U.S. treasuries like they were on clearance at Walmart? Yeah, those days are over. China, which used to recycle its massive trade surplus into U.S. debt to keep its currency cheap, has let the yuan float more freely since 2020. Result? China's foreign exchange reserves have dropped from a peak of $4 trillion in 2014 to $3.3 trillion in 2025, per the People's Bank of China. That's $700 billion less in demand for U.S. treasuries. And don't forget the petrostates, Saudi Arabia, Russia, and the gang. They're pivoting away from parking their oil profits in U.S. debt and instead pouring money into domestic megaprojects. Take Saudi Arabia's Neom, a futuristic city in the desert that could cost up to $1.5 trillion, according to Bloomberg NEF. Less foreign savings flowing into U.S. treasuries, higher interest rates. Are you sensing a theme here, folks? Third, geopolitics is throwing a wrench into the works. Remember when the US and its allies froze $300 billion in Russian assets after the 2022 invasion of Ukraine? Yeah, that sent a message to the world, hey, your savings aren't safe in US treasuries if we don't like your politics. According to the US Treasury's latest TIC data, foreign holdings of US treasuries have stagnated at $8 trillion, down from a peak of $8.5 trillion in 2021, as countries like China, India, and Brazil diversify into gold, euros, and even cryptocurrencies. Less demand for treasuries, higher interest rates. I'm starting to sound like a broken record, but hey, the truth hurts. Now, let's zoom out and talk about the big picture. All these forces, more borrowing, less saving, are pushing up what economists call the natural rate of interest. For you non-nerds out there, that's the interest rate that balances the supply of savings and the demand for investment while keeping employment high and inflation low. Think of it as the Goldilocks rate, not too hot, not too cold, just right. For decades, the natural rate was falling. Why? Well, the baby boomers were saving, China and the petrostates were buying treasuries, and investment demand was weak because productivity growth was slowing and the Cold War peace dividend meant less government borrowing. Bloomberg Economics estimates the natural rate fell from 5% in the early 1980s to a low of 1.7% in 2012. Cheap money everywhere. Mortgages at 3%, stock markets booming, and Uncle Sam racking up debt without a care in the world. But now, the party's over. Bloomberg Economics' latest calculations show the natural rate has climbed to 2.5% in 2024 and is on track to hit 2.8% by 2030. That means the benchmark 10-year Treasury yield, the rate that sets the price of everything from mortgages to corporate bonds, is likely to stay between 4.5% and 5%. And folks, that's the optimistic scenario. If things get really crazy, think climate change investments, booms, or more geopolitical drama, we could be looking at a natural rate above 4% and 10-year treasuries at 6% or higher. Yikes. Now, let's get back to Trump and his obsession with lower rates. He thinks the solution is simple: fire Jerome Powell, appoint a low-rates loyalist, and voila, cheap money for everyone. And hey, with Fed Governor Adriana Kugler's early exit in 2025, Trump's got a golden opportunity to stack the Fed with yes men. The markets are already pricing in a 75% chance of a rate cut in September 2025, per the CME FedWatch tool, thanks to signs of labor market weakness and Trump's meddling. But here's the thing, folks, the Fed only controls short-term interest rates. Long-term rates, like the 10-year Treasury yield, are set by the market, and the market doesn't care about Trump's tantrums. In fact, if Trump undermines Fed independence, he could make things worse. Why? Because investors hate uncertainty. If they think the Fed is just a political puppet, they'll demand higher yields to compensate for the risk of inflation eroding their savings. Just look at history. When President Nixon pressured Fed Chair Arthur Burns to keep rates low in the 1970s, it led to stagflation, double-digit inflation and unemployment. Fun times. Finally, let's talk about the future, folks. Even if Trump gets his way and short-term rates come down, the structural forces pushing up long-term rates aren't going anywhere. Climate change. Bloomberg NEF estimates the U.S. needs to spend $10 trillion by 2050 to hit net zero emissions. AI. McKinsey predicts global companies will invest $3.5 trillion in AI infrastructure by 2030. Defense spending. NATO's new 3.5% of GDP target will add $2.3 trillion to Europe's debt over the next decade, per Bloomberg Economics, and the U.S. isn't far behind, with defense spending projected to hit $1.2 trillion annually by 2030, per the Congressional Budget Office. All this borrowing, all this investment, all this uncertainty, it's a recipe for higher interest rates, folks. And that's bad news for everyone. Homebuyers are already feeling the pain, with 30-year mortgage rates hovering at 7% in 2025, per Freddie Mac. The U.S. Treasury is sweating, with interest payments on the national debt projected to surpass defense spending by 2027, per the CBO. And don't even get me started on the stock market. Higher rates mean lower valuations, and the S&P 500 is already looking wobbly, down 8% from its 2024 peak, per Yahoo Finance. So, what's the bottom line, folks? Trump can scream, tweet, and fire Powell all he wants, but the era of cheap money is over. The structural forces, debt, demographics, geopolitics, and investment booms, are too big to ignore. The natural rate of interest is rising, and with it, the cost of borrowing across the board. For regular folks, that means higher mortgage rates, lower home prices, and tighter budgets. For finance pros, it means a whole new playbook, higher yields, lower valuations, and more volatility. And for the U.S. government, it means a reckoning: either cut spending, raise taxes, or watch interest payments eat the budget alive. But hey, it's not all doom and gloom. Higher rates could mean more investment in AI, climate tech, and other game changers. Just don't expect it to be cheap or easy. And definitely don't expect a new Fed chair to fix it all with a magic wand. Sorry, Trump, this is one problem you can't just bluster your way out of. That's all for today, Econ Junkies. If you like this deep dive into the interest rate apocalypse, smash that like button, subscribe, and ring the bell for more Boss Economics World. And remember, whether it's Trump, Powell, or the natural rate of interest, the real boss of the economy is always economics. See you next time.